the last 12 months, public sector enterprises, which is the PSU companies owned by the government, have had a really good run. It is only that the last 1 month, the stocks have come off a little bit. And the same holds true for the oil marketing companies, commonly known as OMCs, which is BPCL, HPCL, IOC. These stocks in the last 1 year have run up between 90% to nearly 140% for HPCL, 90% for BPCL. Then in the last 7 days, they have come off a little bit. BPCL is corrected about 5-6%, IOC is corrected about 17-18%. They were down Monday trade as well. Now, why could this be happening? This could be happening because the stocks have run up so much that the valuations may be factoring in a lot of positives already, and therefore people may have wanted to book profits. Now, what could these be? So, I have chosen the CLSA view, for example. There are multiple brokerages which have given a view, some positive, some negative. So, CLSA is negative, Citigroup is positive, Jefferies is positive, somebody else is negative. I have chosen the CLSA view. What does CLSA say? CLSA says that the stocks are pricing in much higher than historical marketing margins. Now, OMCs, or oil marketing companies, have marketing business, and CLSA is saying that the margins that they earn in that business, because of the run up that has happened, the stocks are already pricing in the best marketing margins that they can get. They are also saying that stocks are pricing in continuation of near record refining margins. Remember, in the refining business, the stocks are earning a lot of benefits currently, and those margins, or the refining margins, are currently very high. Now, CLSA believes that the stocks are also pricing in those record margins to continue forever, which they are saying may not be possible. And effectively, if you compare, according to CLSA, these stocks, which is BP, HP, IOC, to global peers, then according to CLSA, they are very expensive. Now, some brokerages say that if you look at FY25 earnings, then the stocks are not that expensive compared to global peers. So, depends how you want to look at it. So, for example, brokerages which are positive, Jefferies, for example, is saying that oil marketing companies in the past, 2014 to 2017, enjoyed peak multiples, peak valuation multiples. Currently, the stocks are not there, and therefore, if the stocks were to go to those peak multiples, then there is still some room left for the stocks to gain. मतलब अभी भी थोड़ी तेजी बाकी है. So, the view from Citigroup, the view from maybe Morgan Stanley, and maybe even a Jefferies, is that if there is a correction which is underway right now, they might actually use this correction to buy into these stocks. And why would they do that, aside of the multiples argument, is that they believe that FY25 earnings are looking very stable. So, no problems on that front. The earnings in FY25 that the companies will do is largely predictable. So, that is part one, subject to crude not doing too much. Government was going to infuse 30,000 crores in these companies. They are now not going to infuse 30,000 crores, and therefore, equity dilution will not happen. Simple, right? If the government were to put in money, then there will be equity dilution. That will not happen. So, that is the other positive. And companies individually are doing well. BPCL net debt to EBITDA is only 6,000 crores, which means it's deleveraged quite a bit. It has never happened in the past like this. So, there are some individual company specific factors as well, which might hold them true. All in all, the consensus seems to be that the businesses are doing the right things. The valuations have expanded quite a bit. If there is a correction, companies will go out and buy into these stocks.